Today our secretary didn't come, sir. He's absent. So,
Okay. No.
okay.
Now, is the share on?
Yes, sir. It is on, sir. But the another ID, there is no audio coming. I think, sir. No,
No, I have switched it off.
Oh,
To remain on mute only. Okay.
okay, sir.
It's just for me to see whether the screen share and all is perfect.
So how will plan, sir? Will discuss the queries in between, or will have it
Towards the end. In the
okay,
end.
sir. Either way is okay.
Yeah. Because in between it causes a disturbance.
Disturbances.
Yeah.
Sometimes it takes diverted.
Yeah. So we'll take it in the end. We have chosen issues on 54, 55, which are of common importance.
Okay. Okay, so I'll let all the members inside.
Yeah. No
They'll be
problem.
joining.
How many enrollments do you have? About 50, 70?
No, sir. 80 today.
80. Okay.
It's a medium category, sir.
Okay. No problem. The audio is clear, ma'am?
Yes, sir. It is very clear. Sir, I'm recording the session.
Yeah, no problem.
One copy will be saved in your system also.
Okay.
Automatically.
Okay, great. It will save on the system itself.
System itself. Yes.
Okay. Great. That will be very good.
Yes, sir.
What time do you want me to take the question answers?
Sir, either at the end or in.
No, at the end. How much time do you want to allocate?
Sir, that will see depending upon the questions received, sir. I
Okay,
will
fine.
intimate in the middle of the session so
No
that
problem.
we can plan.
Yeah, no problem. No problem.
Okay, sir. Shall we start the meeting?
Yeah,
Members will
sure.
be joining during
Sure.
the purpose.
Sure.
Very good evening to one and all present here. I welcome all the senior members, past chairman, and members for today's virtual meeting. And I welcome our today's speaker, CA Jagadish Punjabi sir, all along from Mumbai. Sir, hearty welcome, sir. Hearty
Thank you,
welcome.
ma'am.
In fact, sir is addressing for the first time to our Madurai branch. So we are very much happy to have you here with us, sir. And sir is one of the most renowned speaker and the most wanted speaker, particularly in Bombay Chartered Accountants Society in Mumbai. So we shall make use of his expertise, knowledge. And thank you for accepting our invite, sir, in spite of your busy schedule. So today, sir will be addressing on the amendments that has taken place in capital gain area, and only the selected, the complicated issues will be discussed by sir. And as usual, we'll have a query session at the end of the session. Let me give a brief introduction about CA Jagadish Punjabi sir. He is practicing mainly in the area of direct taxation since 1989. He has secured a rank in CA inter examination. He practices in his individual name right now. And he has been a lecturer in accountancy and taxation for a period of 17 years in Ghanshyam Das Saraf Girls College of Commerce and Economics and St. Andrews College of Commerce and Economics. He is a contributor to the feature Triple N News, published in the Journal of Bombay Chartered Accountants Society. He is a member of various committees of Bombay Chartered Accountants Society and of the Chamber of Tax Consultant. And he is a regular speaker at various seminars and also has presented papers and authored various articles. He is also a guest faculty at the training programs conducted by the National Academy of Direct Taxes, Nagpur, and Direct Taxes Regional Training Institute, Mumbai. So with this brief introduction, I welcome you once again, sir. Over to you.
Thank you, Abhinaya ma'am, for your kind words of introduction. Good evening to one and all, the seniors present and the other members here. The topic for today evening discussion is intricate issues in taxation of capital gains. The topic allotted is so vast that we can go on and on, maybe for 3 or 4 sessions equivalent to the session we have today, and we may yet feel that we have not completed the topic, and it's an evergreen topic, a topic which is of interest to a practitioner, a topic which is of an interest to an assessee. Now, what we propose to do is deal with certain issues which will arise in the context of 54 and 54F. The issues which have been selected are ones which are of practical importance and therefore possibly may be of some use to all of you who have taken out of your time out of your schedule to attend the session. Time permitting, we may even go to select 1 or 2 issues on provisions of section 50C, and we shall obviously towards the end of the session take up all the questions and answers which may be arising. To begin with, let's have an overview of the provisions of section 54 and 54F. I'm taking some time to explain the provisions so that when we come to the issues, you will be in a better position to appreciate the issue being raised. At the outset, please note that section 54 grants you a exemption from capital gains arising on transfer of a long-term capital asset being a residential house. Now, of course, there are conditions attached to the grant of exemption, as is the case with all the other provisions. So let's have a look at what are the provisions exactly. To begin with, the section says it is subject to the provisions of subsection 2. Therefore, I definitely need to comply with the provisions of subsection 2. Assuming that I am complying with the provisions of subsection 2, subsection 1 is granting me an exemption if I am an individual or an HUF. Therefore, if I am neither an individual nor an HUF, the provisions of section 54 shall not apply. The provisions shall apply in respect of capital gain which is arising from transfer of a long-term capital asset. Mind you, it has to be not only a capital asset, it has to be a long-term capital asset, which should give rise to capital gains, which I am claiming to be exempt under section 54. And what should that asset be? It says being buildings or lands appurtenant thereto. So the capital asset which I am transferring should be buildings or lands appurtenant thereto and being a residential house. Pay attention here because we have an issue over here. The section is using plural form of buildings. It uses the word or lands appurtenant thereto and being a residential house, the income of which is chargeable under the head income from house property. And to get an exemption, the assessee must, within a period of 1 year before the date of transfer or within a period of 2 years after the date of transfer, purchase one residential house in India. So with the capital gain which I have earned on transfer of a long-term capital asset being a residential house, I must go and buy within the time frame mentioned here, namely 1 year before the transfer or 1 year after the transfer. I must go and purchase one residential house in India. So having sold one, I cannot anymore go and buy 2 houses or 3 houses. So if there is a split in the joint family where a family house is being sold, gain arising, 2 brothers deciding to buy 2 separate houses, you have some difficulty over here because the section grants you an exemption with reference to one residential house, that too in India. The house which you are seeking to purchase should not be situated outside India. Or I must, within a period of 3 years after the date of transfer, construct one residential house in India. So I have 3 options: 1 year before the date of transfer purchase, or 2 years after the date of transfer purchase, or construct within a period of 3 years after the date of the transfer of the long-term capital asset being a residential house. Then to the extent you have utilized the capital gain in purchase of the residential house, purchase or construction, the capital gain shall be exempt. The surplus, if any, will be charged to tax. The section also provides that you shall not transfer the new asset for a period of 3 years. For a period of 3 years from the date of its purchase or construction, you shall not transfer the new asset. Should you choose to do that, the cost of the new asset shall be reduced to the extent of exemption which you have availed under section 54 when you purchased or constructed this asset. Now you also have a proviso. The proviso says, and we will look at the proviso in greater detail. Proviso says that where the amount of capital gain does not exceed 2 crore, the assessee may at his option either purchase or construct, instead of one residential house, you have 2 residential houses. Therefore, proviso is carving out an exception to subsection 1. Proviso is telling you that, look here, if the capital gain which has arisen to you on transfer of your residential house happens to be up to rupees 2 crores, then you have an option to either purchase or to construct not one, as we saw, but 2 residential houses. And however, the option has to be exercised by you, and the option, once exercised, shall not be available again to you for the same or any other assessment year. Now, any other assessment year I can understand, but why is the proviso saying that this option shall not be available to you for the same or any other assessment year? Any other assessment year, fine. This year I'm selling a house, you're giving me an option that you can choose to go and buy 2 houses. But why is the word same mentioned? We'll have a look at it. Now, at the beginning, I mentioned that the provisions of subsection 1 are subject to the provisions of subsection 2. Now, what does subsection 2 say? Subsection 2 says that look here, the amount of capital gain which you are seeking to claim as exempt under this section, if you have not appropriated it within a period of 1 year before the date of transfer towards the purchase of a new house, or you have not utilized it for purchase of construction of the new house before the date of furnishing return of income under 139. Mark the words in red. You must either appropriate it or you must utilize the capital gain for purchase or construction before the date of furnishing return of income under section 139. Then you shall deposit this unutilized amount in an account to be known as a capital gain account under the scheme known as capital gain account scheme. But such deposit should be made not later than due date applicable in the case of an assessee for furnishing his return of income under 139(1). So if I take an example of assessment year 2021, the due date of filing return is 31st of December if you're not going to get your accounts audited under 44AB. Then in that case, the second part of subsection 2 requires me to go and deposit the amount in a capital gain account scheme by 31st December. But on the other hand, if I have an assessee who is covered by tax audit, then he can go and make such a deposit not by 31st of December, but by 31st of January. Right? And the amount deposited in the capital gain account scheme should be used by me for purchase or construction of a new residential house in India. If at the expiry of 3 years, I have not used the amount which I have deposited in the capital gain account scheme, the unutilized amount shall be taxed as long-term capital gains in the previous year in which the period of 3 years from the date of transfer of the original asset expires, and I shall be entitled to withdraw the amount from the capital gain account scheme. Now you may ask me that can I indefinitely postpone the taxation by not withdrawing the money from capital gain account scheme, because capital gain account scheme is giving me income by way of interest. I'm happy with that income, so I will avoid paying tax. The answer is no. At the expiry of the time, at the expiry of 3 years from the date of transfer of original asset, the law expects you to pay tax on the unutilized amount which you have deposited in the capital gain account and which you have not utilized it for either purchasing or constructing a new residential house. Therefore, to recap, what section 54 told me was that assessee should be an individual or HUF. He should transfer a long-term capital asset. The long-term capital asset transferred should be buildings or lands appertaining thereto, being a residential house. The income of the house which I am transferring is chargeable under the head income from house property. The assessee has, within a period of 1 year before or 2 years after the date of transfer, purchased, or within a period of 3 years after the date of transfer, constructed one residential house in India. And the proviso told me that in case long-term capital gain is not more than 2 crore, the assessee may, at his option, purchase or construct not one but 2 residential houses. This option is available only once. Before the date of furnishing the return of income under 139, the assessee must either appropriate the amount of capital gain for purchase of new asset made within 1 year before the date on which transfer of original asset took place, or the assessee must utilize the amount for purchase or construction of the new asset. The amount of capital gain which is not so appropriated or utilized shall be deposited by the assessee in a capital gain account, which account shall be opened under the scheme known as capital gains account scheme, and such a deposit should be made before the date of furnishing return of income under section 139(1). Assuming I am satisfying all these conditions which I have just now narrated, then the consequence will be that I will get a deduction or an exemption. The exemption will be lower of the two amounts. Which are the two amounts? The two amounts are cost of either one or two residential houses, depending on whether I am covered by the proviso or I am not covered. Even if I am covered, whether I choose to be governed by the proviso or I don't choose to be governed by the proviso, and or the exemption obviously cannot exceed the amount of long-term capital gain arising on transfer of the residential house. So this is 54. Let's now look at 54F. Identical timelines. So therefore, what I'll do is instead of running through the entire section as I did in the case of 54, I shall run you through what I consider to be the differences or the important points. First, 54 was subject to subsection 2. 54F1 is subject to provisions of subsection 4. Subsection 2 of 54 is identical to subsection 4 of 54F. So basically, the rules governing the deposit of unutilized amount in capital gain account under both 54 as well as 54F are one and the same. The difference between 54 and 54F is that in 54, the gain which was exempt was one which arose from transfer of a residential house. Here in 54F, the gain should be a long-term capital gain undoubtedly, but the gain should arise from transfer of any long-term capital asset not being a residential house. Therefore, if what I am transferring is a residential house, I can go under 54. If it is any other long-term capital asset not being a residential house, I will be governed by 54F. In 54, I was expected to utilize the amount of capital gains which arose on transfer of original asset being a residential house. In 54F, I am expected to utilize not the amount of capital gain, but I am expected to utilize net consideration which has accrued to me or which is received by me on transfer of an original asset, giving rise to the long-term capital gain which I am seeking to claim it as an exemption. 54 did not tell me that, hey, look here, before you claim exemption, you should not have more than one house or two houses. But 54F does mention that I will not give you an exemption. I will not give you an exemption if you own more than one residential house other than the new asset on the date of transfer of original asset. Let's take an example. I am selling jewelry which is held by me as a long-term capital asset. This sale of jewelry is giving rise to a long-term capital gain. I already own two residential houses. I will not get benefit under 54F. Why? Because the proviso says that the benefit of 54F will not be granted to you if you own more than one residential house other than the new house on the date of transfer of jewelry. Therefore, before I sell jewelry, if I sell one of those houses or I gift away one of those houses, then subject to GAR, I would be satisfying the requirement of section 54F. Let me presume I have only one house on the date when I am selling jewelry. Then the proviso imposes a second condition that having purchased a new house from this net consideration of jewelry, if you go and purchase any other residential house other than the new house within a period of 1 year after the date of transfer of jewelry, then also you will be disqualified from the claiming the exemption. Or if you construct a house other than the new house which you are purchasing for the purpose of claiming exemption under this section within a period of 3 years after the date of transfer, then also you are disqualified. Now, net consideration has been defined to mean full value of consideration received or accruing as a result of transfer of capital asset, that is in my case the jewelry, as reduced by any expenditure incurred wholly and exclusively in connection with such transfer. Subsection 2 tells me what are the consequences of purchasing within the period of 2 years after the date of transfer, or I mean, if I purchase or I construct and I violate the proviso, then what happens? Subsection 4, as I mentioned, is identical to subsection 2 of section 54. Right now, to the extent I have not utilized, I must go and deposit the money in the capital gain account scheme. That's also the condition. So basically, these are, I mean, I have narrated the conditions precedent which I just now discussed. The consequence of satisfaction of all these conditions is that the exemption will be computed not as simply as we did in 54, but here the exemption will be computed by using the formula cost of the new house multiplied by the capital gain arising on transfer of the original asset divided by net sale consideration. Now, the consequences of default, etc., are given here. I have also given you a comparison between 54 and 54F. You may make a reference to this later at your leisure, because the objective of today's session is to deal with intricate issues and one or two new amendments. Now we come to the proviso which has been inserted by the Finance Act of 2019 with effect from 1/4/2020, which is assessment year 2021 is the first year when you can claim the benefit of proviso to section 54, which gave you an option to purchase 2 residential houses instead of 1. The condition for applicability of the proviso is that the capital gain which arises from transfer of a long-term capital asset being a residential house should not exceed rupees 2 crores. Now, and second condition was that having exercised the option to be governed by the proviso, I will not get benefit of the proviso for the same or any other assessment year. Therefore, if in assessment year 2021, I have chosen to claim the benefit of the proviso, in any subsequent assessment year, I shall not be eligible to once again claim the benefit of proviso unless the law stands amended. Now, the significance of the same assessment year. Let me presume that I have 2 houses and I sell both the houses in the previous year relevant to assessment year 2021. The gain arising on sale of house 1 is 1 crore 80 lakh, and the gain arising on sale of house 2 is 2 crores of rupees, and therefore I am well within the limits qua capital gain arising on transfer of each of these 2 residential houses. Can I now contend that gain of house 1 is being invested in 2 houses, namely house 3 and house 4, and gain of house 2 is also being invested in purchase of 2 new houses, namely house 5 and house 6. Therefore, house 1 and 2 are going out, 3, 4, 5 and 6 are coming in, and you tell me, how can you do that? Can I not tell you that I am claiming exemption of proviso because qua each of these gains I am satisfying the conditions of the proviso? The answer would be no. There is a fallacy in this claim. What is it? The proviso, as we saw, says that if you choose to exercise an option of claiming the benefit of this proviso, then the benefit of this proviso will not be available to you for the same or any other assessment year. Therefore, I can choose that I want to exercise, I want to avail of the benefit of the proviso qua gain of house 1, or I may choose to avail the benefit of the proviso qua gain of house 2, but qua both the gains I cannot choose to avail benefit of the proviso to section 54. So that was the significance of the word same or any other assessment year. So that was same. Now we saw in 54 that I can buy a house within 2 years from the date of transfer of the original house. Therefore, if I have sold the house in previous year 1819, I have time up to 21 possibly to purchase a new house. If supposing I sold my original house on 1st January 2019, the gain arose to me in assessment year 1920, which gain I must have deposited in capital gain account, and one of the conditions is that I must now go and purchase within a period of 2 years from the date of transfer of the original house. Today, when I'm going to buy the house, the proviso is in force. But when I deposited the money in the capital gain account scheme, that proviso was not in force. When capital gain arose to me in assessment year 1920, the proviso was not in force. Therefore, my question is, will the proviso apply to purchases made after the introduction of the proviso, or will the proviso apply to gain arising after the introduction of the proviso? To my mind, the proviso applies to that capital gain which arises after the introduction of the proviso. Therefore, if I have sold a house on 1st January 2019, long-term capital gain which arose to me was less than 2 crores. I deposited the money in capital gain account scheme. With that money today, I cannot go and buy two houses and say I am choosing to be governed by the proviso. Proviso is in force today when I am purchasing the house. Therefore, allow me to purchase two houses. No, it will be such a claim will not be entertained. But on the other hand, consider a case where SSC has in 2019 purchased two residential houses for 1 crore each, and on 1/1/2020 he went and sold one residential house. He went and sold one residential house on 1st January 2020. Therefore, he is selling the house when the proviso is in force. The capital gain arising on transfer of the house on 1st January 2020 is 1 crore and 80 lakh. I have already purchased 1 year prior to the date of transfer two residential houses of 1 crore each. I can now contend that, look here, sir, assessment year 2021, the proviso is in force. The proviso is in force. I am choosing to be governed by the proviso. The long-term capital gain which has arisen on transfer of a residential house on 1st January 2020, I am appropriating it towards the purchase of two residential houses made by me 1 year before the date of transfer. Therefore, the point which I am trying to convey is that the proviso will apply to capital gains arising after the proviso came into effect or while the proviso is in force. Do not be boggled down by the date of purchase. Do not say that I am purchasing while the proviso is in force, or do not be under an impression that since I purchased the houses when the proviso was not in force, I will not be governed by the proviso. You will be governed by the proviso if the capital gain arises to you which you are claiming to be exempt while the proviso was in force. That is for all capital gains arising in previous year commencing from 1/4/19 and thereafter, subject to the condition of 2 crores. Now this amendment is in section 54. Similar amendment has not been made in section 54F. So you will have to be conscious of the fact that if what you are transferring is not a residential house but any other long-term capital asset, then you do not have, then you will be governed by section 54F, and therefore you will not have an option to purchase two residential houses instead of one residential house. Okay, now let's look at some of the case studies with reference to the proviso. Let me presume that Mr. A purchased his gold jewelry for 2 crores in previous year 1-2. In previous year 19-20, he goes and sells it for 6 crores. He has invested the gain in purchase of 2 new residential houses. Will he be able to claim benefit? The answer is no. He will not be able to claim exemption either under 54 or under section 54F. The reason is that the original asset which is being transferred is not a residential house, therefore he is not entitled to claim exemption under section 54. As far as 54F is concerned, one of the conditions in the proviso was that having purchased a new residential house, you should not, within a period of 1 year from the date of transfer of the original asset, purchase any other residential house other than the new asset. Now, since he is buying 2 new houses, one of them will qualify as a new asset for the purpose of 54F. The other house will be a violation of the condition small b in the proviso, and therefore he is not qualified for claiming exemption either under 54 or under 54F. Now, let's look at another case study where the person is now selling a residential house, but he is selling it for 20 crores. He had purchased the house for 2 crores, the indexed cost being 6 crores. Therefore, he is getting a gain of 14 crores. He says, I am purchasing not one, but I am purchasing 2 house properties for 4 crore each. Will I get an exemption of 8 crores? The answer is no, because the proviso will not apply as the long-term capital gain is in excess of 2 crore of rupees. For the proviso to apply, the long-term capital gain arising on transfer of a residential house should not be exceeding 2 crore of rupees. Let's look at the third case study. Now here you have a case of an individual who is selling a residential house for 10 crores. The indexed cost of acquisition was 9 crore. He says that I am buying 2 residential house properties of 50 lakh each. Will he get a benefit? The answer of the proviso, the answer is yes. For the reason that the house sold is for 10 crores, the indexed cost being 9 crores, the long-term capital gain which is arising to him on transfer of a residential house is 1 crore of rupees. 1 crore is is an amount which does not exceed 2 crore, and therefore he can avail the benefit of the proviso. He has purchased 2 residential houses of 50 lakh each, which means he has utilized an amount of 1 crore. Therefore, he will be entitled to claim exemption under section 54 to the extent of rupees 1 crore, and he will end up with nil taxable long-term capital gain. Let's look at the last of the case studies in dealing with the proviso. A sold his residential house for 10 crores, which was purchased by him 10 years ago. Therefore, it is a long-term capital asset being a residential house. The indexed cost of acquisition is 8 crores. Therefore, you have long-term capital gain of 2 crores. He is chosen. Now, what has he done? He has purchased one house 1 year before the date of transfer of original house, and another house he has purchased it within a period of 2 years from the date of transfer of the original asset. That is the house which he sold on 2nd January 2020. Will he be able to claim the benefit of the proviso and contend that the investment made in both these houses should be aggregated and the aggregate amount granted to me as an exemption under section 54? The answer appears to be yes. The long-term capital gain arising on transfer of the residential house is not exceeding 2 crores. Therefore, he can avail of the benefit of the proviso and he can contend that allow me to buy not one but two residential houses. Having allowed him to buy two residential houses, the time frame within which he can purchase the residential houses is 1 year before the date of transfer of original asset or 2 years after the date of transfer of the original asset. Now, what Mr. A has done in our case study is that one of the two houses he has purchased it before the date of the transfer. One of the two houses he has purchased it after the date of the transfer. The point which I am trying to explain is that it is not necessary that the two houses which you are claiming to be covered by the proviso should both be purchased simultaneously. One may be purchased before the transfer of original asset, the other one may be purchased after the date of transfer of the original asset. You can have even a combination where you purchase one and you construct the other. Any combination of purchase and construction will qualify you for the benefit granted to you by the proviso. Case study 5, I am leaving it for you to apply your minds and claim it. Let's now come to another issue with reference to section 54F. Now, as we saw, 54F permits me to purchase the house or to construct the house. Purchase can be either 1 year before the date of transfer of original asset, or it can be 2 years after the date of transfer of original asset, giving rise to long-term capital gain, which is being claimed as exempt under section 54F. Since construction has to be within a period of 3 years after the date of transfer, necessarily construction has to be completed within a period of 3 years after the date of transfer of the original asset. The point which I am trying to raise is, can construction commence before the date of transfer? So if I am selling jewelry today, is it necessary that the house which I am going to construct, for which I am going to claim exemption in respect of long-term capital gain arising on transfer of jewelry, is it necessary that the construction should commence after transfer of jewelry, or is it okay that I had commenced construction of the new house, I sold jewelry today, I am further investing in the construction, and the construction will be completed within a period of 3 years from the date of transfer of jewelry. Another question which arises is, assuming that construction can commence before the date of transfer of original asset and construction is completed after and within a period of 3 years from the date of transfer, the second question which arises for your consideration is whether cost incurred before the date of transfer of original asset on construction of this new house will qualify for exemption under section 54F, or will you tell me, no, I am not going to give you this cost because section says that you must construct after the date of transfer of the original asset. Unlike purchase, where purchase can be either before the date of transfer or after the date of transfer of original asset, section 54F necessarily requires that construction has to be within a period of 3 years after the date of transfer. So the option of constructing before the date of transfer is not available to me. That's the second issue. The third issue, which is arising, which we are trying to discuss is it necessary that land also should be purchased by me? If construction has to commence after the date of transfer, is it necessary that land also necessarily should be purchased by me after the date of transfer of the original asset? Right. So these are the issues which I have listed down on the slide. Let's now, incidental question will come that supposing my due date of filing return of income comes and my construction is not over, do I necessarily need to go and deposit the amount in capital gain account, or can I say that no, I have completed the construction within a period of 3 years, therefore where is the question of depositing the unutilized amount in the capital gains account scheme? So now, before we look at what the courts have to tell us on these propositions, let me consider a case study which we shall keep in mind. Having studied the legal position, we shall come back to these figures again and discuss the answers. Now, what we are told is that on 1st November 2019, therefore in previous year 1920, which is assessment year 2021, Mr. Wealthy, who is covered by tax audit, sold jewelry held by him as a capital asset since more than 36 months. Therefore, what he has transferred is a long-term capital asset other than a residential house. He has sold jewelry for 250 lakh. The index cost of acquisition is 50 lakh. Therefore, the long-term capital gain arising on transfer of jewelry in assessment year 2021 is 200 lakh. He has decided to construct a residential house on a plot of land purchased by him for 60 lakh in the year 2015. So my first point is that he is constructing on a plot of land which he has purchased in 2015. Is it necessary that he must now go and purchase a new plot of land, or can he construct on the plot of land which he already holds since 2015, which he purchased for 60 lakh? Assuming that he can construct on this plot of land, will this 60 lakh incurred in 2015 qualify for exemption under section 54F in assessment year 2021 as for exemption of capital gain arising on transfer of jewelry? The construction he commenced in January 2016 when he had not imagined that he is going to transfer jewelry and he will have long-term capital gain. The construction commenced in 16 and is completed in October 2021. Therefore, from November 19 to October 2021, it is a time period of less than 3 years. Therefore, he is well within the limits. Now, I have been given the amount spent by him on construction. These amounts are in addition to the cost of land which he has incurred in 2015. The first is January 16, he began construction. Up to October 18, he spent. Then from November 18 to October 19, he has spent 25 lakh. From November 19 to July 2020, assuming the due date was not extended, July 20 was my due date for filing return of income for assessment year 2021. If he was not covered by tax audit, it was 75 lakh. August 20 to Jan 21 is 50 lakh. Feb to March is 15 lakh, and April to October 21 is spent 85 lakh. Now my questions are whether is it he is saying that I will claim 80% of the entire capital gain as exempt on the ground that I have invested 200 lakh for construction of the house till due date of furnishing return. His due date of furnishing return of income is 31st of January. So up to 31st January, if you add up, he has spent 60 lakh on land plus 40 lakh here. So that makes it 100. This is another 100. So 200 is what he spent up to 31st July. So he's saying that if my due date of filing return was 31st of July, then I have incurred or I have spent 200 lakh, which is 80% of 250 lakh, the net consideration. Therefore, 80% of the capital gain should be exempt. Now, before we get into the issues proper, we need to keep in mind the provisions of 54F. So the relevant portions I have marked in red for you. At the beginning is that the provisions are subject to subsection 4. And when I come to subsection 4, I am told that whatever I have not utilized up to the date of furnishing return of income under 139, I must deposit in capital gain account scheme, but that deposit must not be later than the due date mentioned in 139(1). Now, I have Karnataka High Court in the case of Subramanya Bhatt, as also Allahabad High Court in H.K. Kapoor's case, and Ahmedabad Tribunal in Subhash Bhavnani's case, apart from several other decisions telling me that the section requires that construction should be completed within a period of 3 years after the date of transfer. The section nowhere tells me that construction must begin after the date of transfer. Therefore, these decisions are an authority for the proposition that construction can commence before the date of transfer. It is all right as long as construction is completed within a period of 3 years after the date of transfer of the original asset. Now, having seen this, the next question which arises is that, yes, you have been kind enough to permit me to complete construction which had commenced before the date of transfer of the original asset. But are you going to give me exemption with reference to the cost which I incurred before the date of transfer of original asset? Therefore, in my case, I sold jewelry, if you see, on 1st November 19. The question which I am trying to now answer is, will the cost of construction incurred before 1st November 19 also qualify for exemption under section 54F? Let us see what the judicial view is. The Mumbai bench of the tribunal in Chandru Raheja's case held that only that part of investment in the new house which has been made out of sale proceeds received after the transfer of old house will qualify. Therefore, whatever I have invested in my case study before 1st November 19, going by Chandru Raheja's case, will not qualify. Then you have Hyderabad bench of the tribunal in Nimagada Sridevi's case, where it tells me that investment in new house is not entitled to deduction to the extent the same is made before transfer of original asset. So something identical to what Bombay Tribunal told me in Chandru Raheja's case. So you have Bombay Tribunal and Hyderabad Tribunal telling you that, hey, you can commence construction before. We are not going to disqualify you on that count. But whatever cost you incur on construction before the date of transfer of original asset will not qualify for exemption under 54F. That's the ratio of these two tribunal decisions. Then you have Gujarat High Court in Shantaben Gandhi's case, where the assessee completed the construction before date of transfer, but he did not pay the contractor. He did not take possession of the newly constructed house till he sold the his original asset. Now, when he sold the original asset, from the sale proceeds, he went and paid the contractor the amount. So, cost was incurred before the date of transfer, but it was not paid by him. The actual payment happened after the date of transfer of the original asset. And he also took possession later on. He claimed benefit. Gujarat High Court said, no, we can't allow this. The requirement is that the construction should be completed. Here in your case, construction was completed before the date of transfer of original asset. You merely made payment of the construction cost after the date of transfer of the original asset. Therefore, Gujarat High Court said that what is relevant is not the payment but the actual construction. As far as his contention that I did not even receive possession of the constructed house from the contractor, the Gujarat High Court says this is not a case where because of the fault of somebody else which is beyond your control that you were not able to occupy the house, you chose not to pay the contractor and therefore you did not get the possession. The benefit was denied to the SSC. As against these decisions, we have the decision of Karnataka High Court, very recent one, in K. Ramachandra Rao's case, where Karnataka High Court says that in the entire scheme of 54F, there is no prohibition for the SSC putting up construction out of sale consideration. Therefore, so what if he has incurred the cost earlier? Karnataka High Court went ahead and granted deduction under section 54F, even with reference to cost which was incurred before the date of transfer of original asset. Therefore, in our case, cost incurred before 1st November 19 will qualify for exemption under 54F if we choose to be governed by the ratio of the Karnataka High Court decision in the case of K. Ramachandra Rao. Then you have Madras High Court. Madras High Court comes up with an interesting proposition. It says, yeah, I will give you deduction in respect of cost incurred prior to the date of transfer. However, I will go back in time only to the extent of 3 years. Where does it get 3 years from? Not in the section. Possibly section says 3 years after the date of transfer. So Madras High Court in Aryama Sundaram's case tells me that cost incurred earlier also will be allowed, but I will go back in time only to the extent of 3 years. So if you have purchased land 5 years earlier, the cost of such land I will disregard. You started construction, I will go back and construction cost incurred during a period of 3 years before the date of transfer of original asset, I will give it to you as an exemption under 54F. Whatever you have incurred during a period prior to 3 years before the date of transfer of original asset will not qualify going by Madras High Court. Then you have Bangalore Tribunal. Bangalore Tribunal says, I will also allow you deduction in respect of construction cost incurred prior to the date of transfer of original asset, but I will go back in time only 1 year. Where do they get this 1 year from? Possibly, these are my guesses. It is not stated in the order itself. But 54F allows purchase of house 1 year before the date of transfer. So possibly taking a clue from there, Bangalore Tribunal is saying, I will allow you construction cost incurred, but I will allow you construction cost incurred only 1 year prior to the date of transfer. So in our case study, if I were to be governed by the Bangalore Tribunal decision, I will not get deduction in respect of land purchased. I will not get several other items also. What I will get is only the expenditure incurred on construction during a period of 1 year before the date of transfer of jewelry in my case. Then you have Pune Tribunal in Sohanlal Bhandar's case, where the tribunal says, I will give you exemption even in respect of cost of construction or on purchasing a plot incurred within a reasonable time anterior. Now this is very vague. What is reasonable time? Is 1 year reasonable? Is 3 years reasonable? Is 5 years reasonable? So at least, I mean, I would prefer to be governed by either the Madras High Court or the Bangalore Tribunal. But you must keep in mind the fact that you do have Bombay Tribunal against you, you do have Hyderabad Tribunal against you, but your answer to this could be that once you have a High Court judgment, having the tribunal judgment does not make any difference. The judicial discipline demands that whenever there is a decision of the High Court and that happens to be the only judgment of the High Court, I can be, I mean, that decision will apply throughout the country. It will be binding on all authorities till such time as there is a contrary judgment of a jurisdictional High Court. So therefore, here I have Karnataka High Court telling me I can go back. I have Madras High Court telling me I can go back 3 years in point in time. Therefore, I will choose to disregard the ratio of the decisions of Mumbai Tribunal as well as the Hyderabad Tribunal, and I will say that now that we have Madras High Court as well as the Karnataka High Court, the ratio of these decisions will prevail, and therefore, keeping this in mind, let us now come to the case study proper and look at the figures. If we go by the Madras, by the Bangalore Tribunal, which says that I will give you 1 year prior. Here, the SSC has sold asset on 1st November 19. Therefore, expenditure incurred from October 18 to November 19 from October 18 to October 19, 31st October 19 is what will be qualifying for deduction. Therefore, here you will have 25 lakh onwards, whatever he incurs will qualify. The expenditure incurred on land in 2015 and 40 lakh incurred up to 31st October 18 will not qualify. If you go by the ratio of 3 years and you say that expenditure incurred in past 3 years as has been held by the Madras High Court to be the proposition, then everything will qualify other than cost of land of 60 lakh of rupees. If you were to go by the Karnataka High Court, which does not mention anything, I understand that I can go back in time and I can even claim expenditure incurred 5 years earlier. Therefore, even this cost of land will qualify. To me, it appears that the courts have leaned in favor of the SSC. Going by the literal interpretation of the provision, the construction has to be after the date of transfer. Therefore, to me, of course, personally, I would believe the ratio of the Mumbai Tribunal appears to be a better proposition of the law. But anyway, there have been 2 high courts. Therefore, we will have to respect the view of the 2 high courts of the country. Now we come to the question as to whether whatever has not been incurred up to due date of furnishing return of income in my case, is it mandatory that the money should go into capital gains account scheme, or can I say that no, I have already completed the construction within a period of 3 years. I have substantially satisfied the conditions imposed by section 54F. Therefore, I need not deposit the amount in capital gains account scheme. Assuming I need to deposit, assuming we come to a conclusion that no, deposit is mandatory, then the next question arises, do I deposit by date of filing return under 139(1) as is the express language of 54(2) or 54F(4), or in a case where I have chosen not to file a return by 139(1) date, I file a return later by date mentioned in 139(4), then can I say that expenditure incurred up to date of filing return of income will be granted to me as an exemption, notwithstanding the fact that I have not deposited the money in capital gain account scheme by the date of filing return under 139(1). Therefore, the question is expenditure incurred between 139(1) date and 139(4) date without routing it through a capital gain account scheme, does it qualify for exemption or not? Now, let's look at what the courts have to say. Again, the same decision of Karnataka High Court in K. Ramachandra Rao's case. tells me that if the intention of the assessee is not to retain cash, but to invest it in construction or purchase of the property, and and such an investment has been made within the period stipulated in the section, then the contention that the assessee has not deposited the money in the capital in a bank account as stipulated, and therefore he is not entitled to benefit, is not correct. Therefore, what Karnataka High Court tells me is, have you or have you not purchased or constructed the property within the time period mentioned in 54 or 54F? If the answer is yes, we are not concerned whether you went and deposited the money in capital gain account scheme or not. So this is Karnataka High Court telling you this. To the same effect are the decisions of Chennai Tribunal in M.K. Vidya's case and Kolkata Tribunal in Sunaina Devi's case. However, I must make a mention here itself that you do have a Bombay High Court in Humayun Suleiman Merchant's case telling you exactly opposite of what Karnataka High Court is saying. Bombay High Court says once you come to the due date of furnishing return under 139(1), thereafter, whatever amounts are to be incurred for purchase or construction of the new residential house, they have to be routed through capital gain account scheme. Otherwise, we are not going to grant you exemption under 54 or 54F qua expenditure incurred after the date of furnishing return under 139(1) if the amount has not been routed through a capital gain account scheme. This decision of the Bombay High Court has been stated to be reflecting a correct position in law by the Madras High Court in Venkata Dilip Kumar's case, where the High Court was dealing with an appeal against a writ petition. It was not, a regular appeal under 260A, but it was an appeal against a writ petition. Now you have Madras High Court in a writ petition telling you that yes, non-compliance of 54(2) is only a procedural requirement and therefore you are not going to lose benefit. However, against this writ petition, when revenue came up in appeal to the division bench of the Madras High Court, there were certain observations made to which I will make a reference in a minute or two. Chennai Tribunal and Kolkata Tribunal are on the same lines as the Karnataka High Court. You also have Chandigarh Tribunal and Jodhpur Tribunal. But let us look at what Bombay High Court has to say. Bombay High Court says that no, 54F1 is subject to the provisions of 54F4. Therefore, if you do not satisfy the conditions of 54F4, you will not be granted exemption under 54F1. The exemption will not be available to you. The Bombay High Court says exemption would be available to unutilized amounts only if the mandate of subsection 4 is complied, which means necessarily I must go and deposit the unutilized amounts in a capital gains account opened under the capital gain account scheme. When the Venkata Dilip Kumar's case decided by the Madras High Court in a writ petition came up in appeal before the division bench, the appeal was dismissed on technical grounds. However, Madras High Court considered the ratio of Karnataka High Court and also the ratio of Bombay High Court, and Madras High Court said we are of the prima facie view that the finding rendered in Humayun Suleiman's case, which is the Bombay High Court, appears to reflect the correct position of law. So you have two high courts giving you contrary positions. Karnataka in favor, Bombay High Court against you, but you also have Madras High Court telling you that prima facie, I find Bombay High Court to be the correct, reflecting the correct position of law. Now, if you are in Karnataka governed by the jurisdiction of the Karnataka High Court, undoubtedly you can take benefit of the decision of Karnataka High Court in K. Ramachandra Rao's case. However, if you are not governed by the jurisdictional, if Karnataka High Court is not your jurisdictional court, then there could be some difficulty, but you can still say that going by the ratio of the Supreme Court in vegetable products, wherever two views are available, the view in favor of the SSC should be adopted, and therefore please adopt the view of Karnataka High Court in my case. However, this argument will not be available to those governed by the by the jurisdiction of the Bombay High Court, may not also be available to those who are governed by the jurisdiction of the Madras High Court. On the lines of the ratio of Madras High Court and Bombay High Court, you have Indore Tribunal, Ahmedabad Tribunal, Bombay Tribunal, of course, is bound to happen because Bombay High Court is against you. Now, when we come to the question which I raised, whether is it necessary for me to deposit unutilized amount in capital gain account scheme by 139 one date, or I can hold on till 139 4 date comes, and whatever amount I have spent till then, I will get it as an exemption, even though I have not deposited, or in the interregnum, in the period from 139 1 date to 139 4 date, I incurred amounts on purchase or construction without routing them through capital gains account scheme. Now here the courts have noted the difference in language, which I had pointed out in red in the slide. Let me take you back. If you see, the fifth line makes a reference, fifth and the sixth line makes a reference to date of furnishing return of income under 139. Subsection is not mentioned, but the latter part categorically mentions subsection 1 of 139. Now, in the earlier part, since subsection is not mentioned, courts have taken a view that 139 year would mean 139(4) as well. So, if at all you have incurred whatever amounts you have incurred till the date of furnishing return under 139(4), courts have said, it is the Punjab and Haryana High Court in Jagriti Agrawal's case, it is Guwahati High Court in Rajesh Kumar Jalan's case, and Karnataka High Court in Fatima Bai's case have held. So you have 3 high courts, and now you have Rajasthan High Court as well joining the bandwagon. So you have 4 high courts of the country telling you that where you have incurred the amounts up to 139(4) date, then you will qualify for exemption under 54 or 54F, even though such amounts have not been routed through capital gains account scheme. Therefore, and by and large, that appears to be the preponderant view. The only caution you need to keep in mind is that you should not file a return by 139 one date. If you file a return by 139 one date, then this argument may not be available to you. If you choose to purchase the house after 139 one date but before 139 4 date, then you need not open a capital gains account scheme by relying on decisions of these 4 high courts to which we just made a reference, and contend that since I have utilized the amounts by the date of furnishing return mentioned in 139, I need not have gone and deposited the amount in capital gains account scheme. It is always advisable to err on the safe side if at all you are choosing to be governed by the ratio of these decisions. You will have to ensure that there can always be some litigation. Therefore, please be very clear that the facts of your case are exactly identical or are similar to the facts of the case before the court whose decision you propose to follow. If you are on a planning board stage, it is certainly advisable not to take chances considering the litigious moods of the tax department. Now, a question arises that I have a capital gain of 4 crores. I can purchase one house. I'm talking of 54F. I have long-term capital gain of 4 crores. I satisfy all the conditions of 54F. Therefore, I qualify to purchase one house. So I have purchased a new house, but the new house was worth only 3 crores. Now I still have 1 crore left with me. My question is, can I now go and deposit this 1 crore of rupees in capital gain account scheme and say that give me benefit not only for the cost of the new house, but also for this 1 crore which I have deposited in this bank account. Therefore, don't ask me to pay any tax, because the entire 4 crore which I got by sale of jewelry, I have used 3 crore of rupees for purchasing a new house within the time given to me, and 1 crore I have deposited. Or will the officer say, what's the point? Why are you depositing money in capital gain account scheme? Because money from capital gain account scheme has to be utilized only for purchase or construction. You have already purchased, so you cannot use it further. So why should I give you an exemption? The answer is no. Mumbai Tribunal in Suresh Kumar's case says, despite the fact that I have already purchased one house and it is only one house which I am permitted to purchase, even then unutilized amount I can deposit in capital gains account scheme. This amount which I deposit now will remain unutilized. We understand that, but this will be taxed at the expiry of 3 years from the date of transfer of the original asset. So I can possibly get a tax deferment of 3 years by depositing the amount in capital gains account scheme. Now, where I have deposited the money in the capital gain account scheme, I have not used the money from that account, then I am told that in the previous year, in which the period of 3 years from the date of transfer of original asset expires, this unutilized amount will be taxed as your long-term capital gain, and you shall be entitled to withdraw the amount. I say I don't want to withdraw the money. Let it remain there. Right? I'm getting interest. I'm happy with interest, because even if I withdraw, I will go and put it in a bank fixed deposit. I will get same rate of interest. So let it remain there. I am not withdrawing. Postpone the taxation. Is it possible? The answer is no. Beyond 3 years, you cannot. The mandate of law is that whatever amount remains unutilized in capital gain accounts at the end of 3 years from the date of transfer of the original asset, in that previous year, the unutilized amount will be brought to tax, irrespective of whether you choose to withdraw the amount or you choose to continue, have the amount retained there itself. Okay. Now, the section requires that I must make a deposit, and along with my return of income, I must submit proof of having deposited the money in a capital gain account scheme. Delhi, in the case of Ajit Vaswani, Delhi Tribunal tells me that the compliance with the requirement of making the deposit is a mandatory requirement, whereas submitting proof of such compliance is only a directory requirement. Anyway, in an era of e-filing, this becomes academic, because along with our electronic returns, we cannot anymore file any other proofs, any other documents other than the form of return of income. Okay. So now let's come to another issue. Am I going too fast, or you want me to go a bit slow, or?
No, sir, you please go ahead, sir. In the same manner.
Is the
Yes,
pace
sir,
okay?
fine. Fine.
or are the participants finding it fast? Okay,
Yes, sir,
fine.
please.
Yeah. Okay. Now, the question which now I am considering is whether, with reference to investment in one flat, can I claim exemption under both sections 54 as well as 54F? Therefore, what I am trying to now explain is that I have sold house, which was a long-term capital asset. I got long-term capital gain. I also have long-term capital gain on sale of jewelry or land. Long-term capital gain on sale of house qualifies for exemption under 54, whereas long-term capital gain on sale of jewelry or land qualifies for exemption under 54F. Both these sections require that I must either purchase a new house or I must construct a new house. The timelines given in both the sections are identical. Therefore, my question is, can I now go and buy one house and qua the investment in that one house, say that I want exemption under 54 also and I want exemption under 54F also? Or are you going to tell me that how is this possible? This is not possible because you are purchasing only one house. 54 requires one house, 54F requires another house. Therefore, you must go and buy two houses. Let us look at what the position is. Now, Mumbai Tribunal in Deepak Beda's case has dealt with the case of an assessee who claimed deduction under 54 and 54 EC. The officer said, no, qua the same gain, I will not give you deduction under both the sections. This, to my mind, was ridiculous because the assessee was shelling out money twice. He was shelling out money for house. He was also shelling out money for investment in bonds. Whereas the case which I am trying to discuss with you is a case where I am buying only one house. So money is going only in one asset, but exemption is being claimed under two sections. Whereas in the case before the Bombay Tribunal, money went in two assets, exemption was claimed under two different sections. So 54 and 54 EC, I can quite understand. But when I come to 54 and 54F, I am told, when I read the provisions, I find that there is no restriction in either of these sections which says that they are mutually exclusive. There is nothing which says that once you have invested an amount in purchase of a house which you have claimed it under 54, such house or any further investment in this house will not qualify for exemption under 54F. Such a provision is absent. Incidentally, I have a Hyderabad tribunal decision in Venkataramana's case where the assessee earned long-term capital gain on transfer of two separate assets. One was house property. He claimed, he went and purchased one house and he claimed exemption under both. The CIT appeal confirmed what the AO did, but the tribunal held in favor of the assessee. Therefore, I have at least one tribunal decision telling me that yes, you can claim deduction under both 54 and 54F qua the same house. Now, there the difficulty will be what should be the amount of exemption. So let's look at an illustration or a case study, if you may so choose to call it. Let me presume that on 1st October 2018, the assessee sold a residential house for 100 lakhs, which resulted in a capital gain of 60 lakhs. He purchased a new house for 100 lakhs and claimed the entire capital gains to be exempt. Therefore, out of 100 lakh sale consideration, his long-term capital gain was 60. This was sale of a house. Capital gain arose on sale of a house. Sale of a long-term capital gain arising on sale of a house is governed by section 54. Section 54 requires that I must invest capital gain. It does not require that I must invest the net consideration. Therefore, the assessee purchased new house for 100, claimed 60 as exempt. Therefore, his taxable capital gains in assessment year 1920 was nil. Then came a subsequent year. In subsequent year, in October 19, he sold a vacant plot of land for 100 lakh, which resulted in a capital gain of 40 lakh. Now, remember, the house which he purchased, the new house which he purchased was for 100 lakh, and out of 100, he had claimed exemption of only 60. So 40 out of 100 was something qua which he has not claimed any exemption. The question is, can he claim exemption under 54F for investment made in that same residential house? Because 54F says that you can go and buy a house 1 year before the date of transfer. Date of transfer now is 1st October 19. 1 year before that, therefore I can go back up to what, 30th September 18, but he has on 1st April 19 itself purchased a new house. Let us look at what are the options. This is the capital gain computation of the assessee for assessment year 1920 on sale of a residential house. Consideration 100, index cost 40, gain was 60. This gain has been used for purchase of the house. Therefore, taxable capital gain is nil. Now comes the subsequent year, assessment year 1920. Now, total investment in the new house is 100. Exemption availed is 60. Now, the issue which we have to debate is whether for the purpose of 54F, do I consider that he has invested 40 or do I consider that he has invested 100? The new house was purchased for 100, but out of this 100, I have got exemption of 60 under section 54 in assessment year 1920. Therefore, one view could be that only 40 out of 100 will qualify for exemption under 54F in assessment year 2021. Now, if you accept this proposition to be correct, then in assessment year 2021, on sale of vacant land for 100, you had a long-term capital gain of 60. You are going to now claim exemption under 54F. 54F says cost of new house. I am saying cost of new house to the extent it was not claimed as exempt under 54 is 40. My net consideration on transfer of the vacant land was 100. So 40 out of 100 has been invested. So 40% of capital gain of 60, that is 24, will be exempt and 36 will be taxable. This is one way, one view. The other option is for me to say that no, entire 100 qualifies, and if entire 100 qualifies, the entire 60 also will qualify. Now, let us look at some other provisions. Is it possible to claim deduction with reference to same amount under both the sections? I will contend that yes, it is possible, for the reason that wherever legislature wanted that qua the same amount you must not claim deduction under two sections, legislature has very clearly stated so. But it has not done so when it came to 54 and 54F. Let us look at it. When you come to 80CCC subsection 3 and you have claimed a deduction, once upon a time limit under 80CCC was 1 lakh, limit under 80C was 1,50,000. So it was possible for me to subscribe to a pension cum life insurance policy for 1,50,000, claim 1 lakh under 80 triple C and balance 50,000 come and claim it under 80C. But the entire 150, I could not have claimed it under 80C if I had availed of 80 triple C to the extent of 1 lakh. And this was made very clear by 80 triple C subsection 3, which says a deduction with reference to such amount shall not be allowed under 80C. So, qua the same amount which you are claiming under 80 triple C, you will not be allowed deduction under 80C with reference to the same amount. But qua the balance, you were free to. Same to the same effect is deduction under 2AA 30 the scientific research etc., where you are told no deduction in respect of such amount shall be allowed under any other provision of the Act. Then to the similar effect is the language of subsection 9A of section 80HH. Therefore, considering all these, one can conclude that wherever the legislature wanted that with reference to the same amount, SSC must not claim deduction under two different provisions of the Act, legislature has stated so expressly in 54 and 54F. Such a language is consciously absent, and therefore, qua the same amount of 100, I will, even qua the 60 which I have claimed it under 54 last year, I will once again get a deduction under 54F. The only possible argument which can be canvassed by the revenue against the SSC could be the decision of the apex court in Escort's case, where the Supreme Court said that qua the same amount, you cannot get multiple deductions under the Act. That is something which possibly may come in the way of the SSC. But the second, that is why I have in the case study shown only the second alternative, where the first alternative, if made, could possibly be again contrary to the ratio of the Supreme Court. Now, this is a small issue. Just let me only make a mention of the issue. Here, the issue is, if you recollect 54F, one of the conditions was that I must not own more than one house other than the new house on the date of transfer of the original asset. The meaning of the word own. Does own mean absolutely owned by me, or in case I am holding an asset, a house jointly with my wife, can I say that no, this house is not owned by me, because own means it is entirely mine. Here it is not entirely mine. My wife is 50% owner of the flat. Therefore, possible to argue that neither she nor me own the house. We both have an interest in the house, but we are not necessarily the owners of the house. This proposition is supported by the decision of the Madras High Court and in P.K. Vasanti Rangarajan's case, Delhi High Court in Kapil Nagpal's case, as also Karnataka High Court in Jennifer Bidet's case. Therefore, the proposition which I am trying to canvass is that if at all the assessing officer tells you that you already own another house, and if that another house which you own is held by you not in your individual capacity entirely but jointly, then you will be within your rights to argue that no, this is not a contravention of the provisions of 54F. You can even consider the ratio of the decision of the apex court. If you recollect earlier, in the context of depreciation claim was denied where the SSC was a part owner of the house, part owner of the asset, on the ground that the SSC does not own the asset. To overcome the ratio of the decision of the apex court, legislature amended section 32, and you now have in section 32 that you should be owning the asset wholly or partly. Therefore, even a part owner now gets depreciation, which was not allowed earlier, or was rather not allowable in view of the decision of the apex court, which the legislature sought to overturn. When legislature amended 32, legislature could have chosen to amend 54F also to say that the assessee should not own more than one house wholly or partly. Legislature chose to overrule the decision of the apex court only in the context of 32 and not in the context of 54F. Therefore, for the purpose of 54F, I would say that own would means owned entirely by the assessee. Joint ownership will not qualify as ownership. Now I come to the next issue, namely, does transfer of land which is appurtenant to a building qualify for exemption under section 54? If you recollect, I pointed out that 54 says that the assessee must transfer a long-term capital asset being buildings or lands appurtenant thereto and being a residential house. Now consider a case where I was owner of a land. I constructed a house on that land. So I was owning land since 5 years or 7 years. On that land, I constructed a house. The cost of land is known to me separately. The cost of the house is known to me separately. I decide to sell the house. Now, when I sell the house, I am necessarily selling the land beneath the house as well as the superstructure. But I am selling a house. You as a buyer, you say I am not interested in what you are charging for land and what you are charging for the superstructure. I am giving you a crore of rupees. Now it so happens that when I am transferring the house to you, the land is a long-term capital asset. The superstructure is a short-term capital asset. Capital gain arises to me on transfer of this house to you. The question is, I will get deduction under which section? Rather, I will get exemption under which section? 54 or 54F, or are you going to tell me neither? What have I transferred? Well, my transfer document to you is one composite document where I say I am transferring my house to you. By transferring the house to you, what I am transferring to you is the superstructure as well as the land beneath the superstructure. Now, the consideration is composite, but two assets are being transferred, land as well as the superstructure. So what will happen? Two gains will arise. One will be gain on transfer of land, which will be a long-term capital gain because land was held by me as a long-term capital asset. Another gain will be gain on transfer of superstructure, which will be a short-term capital gain because the superstructure in the facts of my case, I am saying was held for a period of less than 24 months. The 24 months is the period now required to qualify as a long-term capital asset if the capital asset is immovable property being land or building or both. Now, the question arises that if you tell me that the capital gain arising on transfer of land in the facts of my case will qualify for exemption under 54F, I will not qualify because I already own more than one house on the date of transfer of this house. So I have two other houses, therefore I am out. Therefore, I am trying to canvass a proposition that I want to be covered by section 54 even qua the capital gain arising on transfer of this land. Okay. Now, this exactly were the facts of the case before the Karnataka High Court in C.N. Anantharam's case. Now, in C.N. Anantharam's case, the Karnataka High Court considered the ratio of the earlier unreported decision of Karnataka High Court in Azra Abdullah's case, where the assessee, where the question before the Karnataka High Court in Azra Abdullah's case was whether sale of land appurtenant to the building is entitled to benefit of 54 or not. Very pointed question. My case, the facts which we are now discussing are much better to the facts of the case before the court in case of Azra Abdullah. In Azra Abdullah, the assessee did not transfer the building at all. So along with the building, there was land appurtenant there too, land adjacent to the building. What he transferred was only the land adjacent to the building. And he said the capital gain arising on transfer of land adjacent to the building, I want it as an exempt, not under 54F, but I want it under 54. The Karnataka High Court examined it and it's referred to several judgments. And what did Karnataka High Court say? Karnataka High Court says that what has been sold was part of that property which is contiguous to the building. The test whether the sale is in relation to the residential house is satisfied. The sale is in relation to the residential house, and what was sold was land contiguous to the residential house. When land and house form one contiguous whole, the two cannot be separated for the purpose of taxation. If that is so, part of such property which is now sold, even though the part which is now sold, which is land, which is appurtenant, may not be a residential house, still it must be held that it was a land appurtenant. Understood in this manner, the Karnataka High Court in Azra Abdullah said that yes, the assessee qualifies for exemption under 54. Now, in the case of Anantram, it was the assessee who transferred the superstructure along with the land underneath the superstructure. It was not the case of the appurtenant land. The officer computed two separate gains. He computed gain qua land separately. He computed gain qua the superstructure separately. There was no dispute on that count. But having computed, he denied the benefit of exemption under 54 on the ground that 54 requires the asset sold to be a residential house. What you have sold is not a residential house. What you have sold is land beneath the residential house. Therefore, it is not a house, and therefore 54 does not apply. Qua the structure, he said this is a short-term capital gain, and therefore anyway 54 does not apply. So he says for 54 to apply, both the gains should be long-term. If one of the two is short-term, I am not going to give you deduction or exemption under 54 is what the AO said. The tribunal also denied the benefit. But when the matter came to the High Court said, now what was the reasoning of the tribunal? The tribunal read the word or. We saw the word or there. Capital gain arising on transfer of a long-term capital asset being buildings or lands appurtenant thereto. This word or was understood by the tribunal to mean and. They said or here has to be read as and, only then it will become a residential house. The Karnataka High Court referred to Azra Abdullah and said, no, this or has to be understood disjunctively in the context in which it has been used. It cannot be read as and. If we read it as and, it will amount to the court rewriting the section. The court went ahead and granted deduction under section 54 in respect of capital gain, that part of capital gain arising on sale of house which admittedly was attributed to land which was a long-term capital asset. The court held that this is the only view. If sale of land appurtenant can qualify under 54, why can not land which is beneath the superstructure qualify for exemption under section 54? So this was another issue which we saw in the context of 54, 54F. Madam, you want me to continue or you want me to take the question answers, or you can tell me when you want me to
So
stop?
we received around 4 to 5 questions. I think we can have it at the end, sir. You can proceed.
Yeah, so I
Not
can
much
proceed, right?
questions. Yes, sir.
Yeah,
Yes.
yeah. Okay, fine. Okay, now comes the question whether the exemption under section 54, 54 EC or 54 is to be computed with reference to capital gains by which have been computed by applying 50C, or do I compute exemption with reference to capital gains, which capital gains shall be computed without taking into consideration the provisions of section 50C. Now, as you know, 50C is a deeming fiction. 50C says that when you transfer a capital asset being land or building or both, and full value of consideration received or accruing as a result of transfer of such a capital asset being land or building or both is less than the stamp duty value of the asset so transferred, then the stamp duty value shall for the purpose of section 48 be deemed to be full value of consideration. Therefore, 50C is a fiction. By a fiction, stamp duty value of the asset which happens to be greater than the consideration agreed between the parties is considered for computing capital gains and for the purposes of section 48. Okay. Now the question arises that for 54F, I need to invest net consideration. Supposing 25 lakh is the agreed consideration and stamp duty value is a crore of rupees, then you are going to compute my my capital gains which are to be charged to tax by taking full value of consideration to be a crore of rupees. Now, if you expect me to invest a crore of rupees to gain exemption with reference to the entire capital gain, I will contend that law is expecting impossible from me. I have received only 25 lakh. How are you expecting that I should go ahead and invest a crore of rupees? Now, if we accept that 50C is a fiction, which admittedly it is. I mean, nobody can dispute that 50C is not a fiction. Now, if it is a fiction, it has to be carried to its logical end, is one way. The second proposition is that the fiction has to be confined only for the purpose for which it is enacted. The fiction in 50C has been enacted for the purposes of section 48. Therefore, do not let this fiction travel to 54 EC or 54F. These very arguments were there for consideration before the Bombay High Court in the case of Jagdish Dabalia. The Bombay High Court was dealing with the case of an assessee who transferred land for 21 lakh approximately. The stamp duty value was 50 lakh of rupees. The capital gain was 21 lakh. The sale consideration was 25. And the assessing officer determined the stamp duty, the capital gains by adopting 50C to be a much greater figure. Therefore, he charged extra amount to tax. He granted a deduction or exemption under 54 EC only with reference to 25 lakh of rupees. The assessee said, I got 25, I invested 25. How do you expect me to get anything more? Right. Now, the assessee's contention was as I said, that deeming fiction has to be given effect only for the limited purpose for which the same has been enacted. The provisions of 50C, 54EC require a harmonious construction, and it is going to be impossible for me to, I mean, legislature cannot expect impossible from me. The legislature cannot expect that when I have got 25 lakh of rupees, I should go and invest in bonds anything more than 25 lakh of rupees. The revenue's contention was, no, 50C is a deeming fiction, give full effect to the deeming fiction. There can be another debate as to what is the difference between the stamp duty value and the full value of consideration. Is that something which can even ever qualify for exemption under 54, etc., could be a separate debate, which I am not for the moment dealing with. The court in Jagdish Davalia's case said that yes, we agree with the proposition which is canvassed by the Council of the SSC that the deeming fiction must be applied in relation to the situation for which it is created. The court agrees, but the court says that while giving full effect to the fiction, if what we are getting, the automatic fallout of giving full effect to the fiction is that the SSC must therefore invest the entire stamp duty value, or must invest the gains computed with reference to the stamp duty value. He cannot contend that I will invest only gains computed with reference to the agreed consideration and then give me the entire capital gains as exempt. They said that if we accept your interpretation, which means the interpretation of the SSC, then such an interpretation will render the provisions of section 50C redundant. Therefore, the court negated the contention of the SSC. So while accepting that yes, we agree with your proposition, but because your proposition is leading to making the provision of the act redundant, we are not going to accept your proposition, is what the Bombay High Court in Jagdish Davalia's case said. Now, there is an impression that the Karnataka High Court in Gauli Mahadevappa's case was dealing with an identical issue in the context of section 54F. And Karnataka High Court has expected the SSC to make an investment with reference to the stamp duty value. Well, that was one of the questions for consideration before the Karnataka High Court. The Karnataka High Court, rightly or wrongly, has not discussed anything on the proposition whether 50C applies, I mean, whether for the purpose of making an investment which qualifies under 54F, should it be the stamp duty value which should be regarded as net consideration, or should it be the full value of consideration which has been received or which has accrued to the SSC, which should be regarded as an investment to be expected to be made so as to enable an SSC to gain exemption for the entire capital gains which have arisen to him. Now, this proposition is not something which I am saying. This is a proposition which has been made by the tribunal, in Jaipur bench of the tribunal, in the case of Rajkumar Parashar. Now, Rajkumar Parashar was dealing with the same facts as I am trying to discuss, namely that the stamp duty value was greater. The SSC said, I will invest only what I have received, but you give me an exemption for the entire gain. The arguments of the SSC there were that, look here, there is a doctrine of impossibility of performance. Legislature cannot expect me to perform the impossible. If I have received what I have received under the document of transfer, or under the agreement of transfer, you cannot expect me to invest something more than that. Then the reliance was placed on several decisions of the tribunal, namely Jaipur bench in Gyanchand Batra's case, Delhi tribunal in Nilofar Singh's case, Jaipur tribunal again in Nandlal Sharma's case, Prakash Karnawat's case, Mumbai tribunal in Raj Babbar, etc. Then it was explained to the tribunal, or it was contended, that Gauli Mahadevappa did not deal with this similar issue. Then they said that assuming that Gauli Mahadevappa or the Karnataka High Court did deal with it, the issue is highly debatable, and considering the ratio of the Supreme Court in vegetable products, you must follow the view which is in my favor. Look at Bajaj Tempo. Supreme Court said incentive provision has to be construed liberally. These were the arguments canvassed by the SSC before the Jaipur bench of the tribunal in Rajkumar Parashar's case. What did the tribunal say? The tribunal said that the consideration determined under section 50C, which is based on stamp duty value done by the stamp duty authority, is certainly not a consideration which has been received by or has accrued to the SSC. Rather, so says the Jaipur tribunal, it is a value which has been deemed as full value of consideration for limited purpose of determining income chargeable as capital gain. So it is a value which has been deemed to be full value of consideration, but this fiction is only for the purpose, limited purpose of determining the income chargeable under 48. The subject issue was not for consideration before the Karnataka High Court. So now I can with authority argue before any bench of the tribunal and contend that, look here sir, Gauli Mahadevappa, this proposition was not for consideration. I am not saying this. This is what has been said by the Jaipur bench of the tribunal. And if some bench wants to disagree with this proposition, possibly a special bench will have to be constituted. Therefore, you do have a Bombay High Court against the SSC. You have Rajkumar Parashar Jaipur Tribunal in favor of the SSC. But please note, Jaipur Tribunal has not considered the Bombay High Court decision. Jaipur Tribunal wrongly has not considered the Bombay High Court decision. Therefore, you will have a situation where possibly revenue will say even Karnataka High Court in Gauli Mahadevappa is against you, Bombay High Court is against you. You have a couple of tribunal decisions in favor. So this is a area where you should be really cautious about. Right? Now let us come. You want me to take one more issue, ma'am? Or you want me to take questions, or what do you want me to?
Yes, sir. Please go ahead, sir.
Go ahead.
Only one.
One issue. Yeah. Okay. Now the last issue on section 50C, a small one. Now 50C, as we said, applies to transfer of a capital asset being land or building or both. Question arises whether will 50C apply when what has been transferred is not land or building or both, but what has been transferred is rights in land or building or both. What do I mean when I say rights in land or building or both? I am making a reference to development rights. I am making a reference to tenancy rights. I am making a reference to booking rights. I am making a reference to leasehold rights in a plot of land being transferred. Therefore, one lessee transferring his leasehold rights to somebody else, whether 50C will apply or not is what I am trying to cover up over here. Well, one may say that you have several decisions of the tribunal to say that 50C applies to transfer of rights, to transfer of land or building or both, and does not apply to transfer of rights in land or building. Which are those decisions? You have decision of the Ahmedabad bench of the tribunal in Yasin Godil's case, You have again Ahmedabad Tribunal in Devendra Ben Barot's case, where SSE transferred rights in land, and the tribunal said rights in land cannot be equated to land or building or both. You have Jaipur Tribunal in Tarachand Jain's case, where the SSE transferred rights which he held as a Kashtakar, which is something akin to a lessee. The tribunal said Act recognizes the distinction between land or building and right in land or building under 50C, and therefore the Act has given separate treatment to land building, and to rights in land or building. 50C will not apply to transfer of rights in land or building. You had an aberration in the decisions of Mumbai Bench of Tribunal in the case of Chiranjeev Lal Khanna, where the Mumbai Bench of Tribunal held that 50C does apply to transfer of development rights. Against this decision, appeal has been admitted, and last when I checked, it was pending removal of the objections. So therefore, this is an open issue to be considered by the Bombay High Court in the case of Chiranjeev Lal Khanna. Following Chiranjeev Lal Khanna, you had Arlette Rodriguez, Myrtle D'Souza, and Arif Akhtar Hussain. Other than these decisions, I am not aware of tribunal decisions holding that 50C applies to transfer of rights in land or building. On the other hand, you have Shakti Insulated Wires, Mumbai Tribunal, and also Voltas Limited telling you that 50C will not apply to transfer of development rights in land. So when I transfer development potential of the land, I am not transferring land, I am transferring only the development potential, and therefore 50C will not apply is the ratio of Voltas Limited. Earlier, Bombay Tribunal in the case of Atul Puranik had held that transfer of leasehold interest in the land will not attract 50C. Against this decision of the tribunal in the case of Atul Puranik, the department did not prefer an appeal to the High Court. Thereafter, tribunal in the case of Greenfield Hotels followed the earlier decision in Atul Puranik and again held that the transfer of leasehold interest in land will not attract provisions of 50C. Department came to the High Court against this decision of the tribunal in Greenfield Hotels. The Bombay High Court said that what has tribunal done in Greenfield? It has followed its earlier decision in Atul Puranik. Now, you did not prefer an appeal against the decision of tribunal in Atul Puranik. So what is your grievance now if the tribunal in Greenfield has chosen to follow its own decision in Atul Puranik? For this proposition, the tribunal relied upon the decision of the Supreme Court in the case of Satish Shah, where Supreme Court has laid down a salutary principle that where revenue has accepted the decision of the court or tribunal on an issue of law and has not challenged it in appeal, then a subsequent decision following the earlier decision cannot be challenged. Similar was the ratio of the Bombay High Court in the case of Hitex products. However, in the case of Cancast Private Limited, Bombay High Court was once again revenue came up to the Bombay High Court contending that tribunal has erred in holding that 50C does not apply when leasehold rights in land are transferred. The Bombay High Court chose to admit the substantial question of law on the ground that when we, that is the Bombay High Court, did not accept the appeal in the case of Greenfield and Hitex, we were not informed about the decision of Bombay High Court in Pradeep C. re-rolling mills where appeal has been admitted. Therefore, now you have two cases pending before the Bombay High Court, one in the case of Cancast and one in the case of Pradeep C. re-rolling mills, where the substantial question of law has been admitted. This over and above the appeal pending in the case of Chiranjeev Lal Khanna's case on the applicability of 50C to transfer of development rights. Then in the case of Heki Bomi Dadi Seth, the AO having accepted the return issued a reassessment notice on the ground that 50C value is more, and you have computed capital gains with reference to the agreement value and not with reference to stamp duty value. The assessee came up in a writ petition to the Bombay High Court contending that the AO has no case. Look here, the appeal, what I have transferred is a leasehold interest in land. Going by Bombay High Court in Greenfield Hotels, 50C does not apply to transfer of leasehold interest in land. Therefore, where is the question of income escaping assessment? The Bombay High Court negated the contention by saying that the decision of the court in Greenfield Hotels did not independently rule appropriate interpretation of 50C. Therefore, in other words, the Bombay High Court said that appeal in Greenfield was not admitted on a technical ground. We have not independently ruled on the interpretation of section 50C to transfer of leasehold rights. Therefore, all that I am pointing out to you is that you need to be trading with caution. You need to be advising your clients with caution that there is a potential litigation, there is a possibility of the case being decided by the High Court contrary to what the ratio of the tribunals has been. And you have Rajasthan High Court in Ramji Lal Meena's case directly telling you that no, 50C will apply to transfer of rights in land or building, though one may not agree with the reasons given by the Rajasthan High Court, but the conclusion of the Rajasthan High Court, whatever that may have been the reasons, is that yes, the provisions of 50C will apply to the case of an assessee who transfers not necessarily land or building, but rights in land or building. Lastly, in a minute or two, I make mention of the decision of the Bombay High Court in the case of Jai Hind Siaki Limited, where Bombay High Court was dealing with the interpretation of section 40 of the Finance Act of 1983. Now, as you may be aware, wealth tax on closely held companies was levied by virtue of section 40 of the Finance Act of 1983. Certain assets were listed down, and on those assets, those were the assets to be considered for computing net wealth of a closely held company. One of the items of assets there was land other than agricultural land. The assessee had taken plot of land on lease. Therefore, he was a lessee of the plot. He was not the owner of the plot. So what he owned was not land. What he owned was the rights in land, namely leasehold interest in land. He did not offer the value of these rights in his wealth tax return. The matter traveled to the High Court. The High Court was therefore concerned with the question as to whether leasehold rights will qualify as land other than agricultural land. Of course, it is not agricultural land. Therefore, the question was whether leasehold rights will qualify as land and therefore are to be included. The question was the expression land will include any interest in land also. That was the question. Whether the expression land will include any interest in land also. The assessee submitted that leasehold interest is not includable. The court held that no leasehold interest in open land for the purposes of section 40 of the Finance Act 1983 would be includable, would be included in the expression land, and therefore it is chargeable to wealth tax. Now your language of 50C is still the same. Therefore, possible that the court may adopt the meaning of the expression land given in the context of section 40 of the Finance Act 1983 for the purposes of 50C. Of course, you do have an argument that 40 of the Finance Act did not make a distinction between land and rights in land, whereas in income tax you have plethora of sections which make a distinction between land and rights in land. Therefore, Income Tax Act is conscious of the distinction between land and rights in land. If legislature wanted rights in land also to be covered by 50C, it could have expressly stated so, as it has done in several other provisions. That could be the contention which one may take up to distinguish or to contend that the ratio of the Bombay High Court in the case of Jehan Siaki will not be applicable for the purposes of section 50C of the Act. I think with this I have covered quite a number of issues within the time allotted to me. Of course, there are several others which I have not been able to cover for want of time, but I mean, respecting the time allotted, I have reached exactly the limit of 2 hours and maybe a couple of minutes more.
Okay, sir.
Yes, madam, over to you.
Yes, sir. Sir, we received queries. Can you please stop sharing, sir? I will
Yeah,
share this.
I will do that. Yeah. Yes, madam. Madam, you may, do you mind reading it out? Yeah.
No, I will share the screen, sir. I filtered only the questions.
Okay.
What are not.
Okay, fine.
Sir, one more thing. I'll release the audio control also. Okay, sir. Audio control is also been released. So, member whoever wants to interact with you, they can interact, sir.
Yeah, sure.
By themselves. So, I have listed all the questions received from them. Is it visible, sir?
Just give me a minute. Yeah. The SSE is holding an unlisted non-convertible debenture redeemable after 36 months with a premium of 10%. Can the SSE claim long-term capital gain with indexation either on redemption or to transfer before maturity to have the benefit of long-term capital gain? I would believe for debentures, indexation is not available and therefore you will not be able to claim indexation. Capital gains will arise only when there is a transfer of a debenture. Now, therefore, if you are holding the debenture to maturity, it is highly debatable whether the premium which you get will qualify as long-term capital gain or it will go as income from other sources. You already have, in the context of deep discount bonds, a circular of the CBDT explaining you that if you transfer the deep discount bond before its maturity, it will give rise to capital gain. But if you choose to hold the bond till its maturity, the income which arises will not be capital gain, but it will be taxed as income from other sources. I would guess that you will be in for a litigation if you are holding the debenture till maturity and then choosing to offer the surplus as capital gains and availing of the concessional rate of tax.
Okay, thank you, sir.
Question number 6.
Yeah, and SSE takes improvement of immovable property, and when he says the same, what are the documents to be produced to claim indexation for the cost of improvement since the assessment is faceless. In the faceless assessment, you will be given an opportunity, a notice will be issued, you will have to produce all the evidences to substantiate the improvement which you have carried out. First, what you have carried out should constitute an improvement. Second, you will have to substantiate with documentary evidence the proofs and the bank statements or the supporting bills, vouchers, etc., that you have actually incurred the expenditure on improvement.
Okay, thank you, sir.
This is something which is dealing with 68, 69, and therefore 115 BBE. And therefore, I mean, without giving adequate background of the said provision, I would not like to deal with this question over here.
Okay, okay.
But let me just make a brief mention. The assessee is a trust registered under 12A and consideration received is greater than the guideline value, but registered with the guideline value for stamp duty purpose. Okay. So therefore, you are admitting that you have received more than the guideline value, but you have prepared the document with reference to guideline value. Investment it is made with reference to actual received, consideration received, whether the trust can be assessed with excess investment under 6869. Under 6869, assessment can be made if the income is from an undisclosed source. So if you can establish, that the source of the funds is the transfer of that very same asset, and you have impeccable evidence to establish that proposition of yours, then you can possibly argue that yes, this amount should not be taxed under 6869, but should constitute capital gains or should constitute a consideration, full value of consideration. But if you have made an investment with reference to the actual consideration received, I see no reason why you chose to have the document with reference to only stamp duty value and not with reference to the differential. I mean,
because the seller, it is the trustees wanted to bring the entire consideration in the books of account. That is the reason.
So therefore, it could have been brought as a sale consideration itself. No, there was no reason to bring it.
But the person,
I could understand if somebody,
the person buying it, is not the person buying it doesn't like to pay more stamp duty.
Okay.
That is why he wanted to restrict to.
So if you can establish that he paid you by check and he paid you only because of this, because how did he pay you for?
Right. Okay.
Yeah.
Okay.
A family arrangement does not amount to transfer, sir.
Okay.
There are several Supreme Court decisions.
Okay.
Right. Yeah. Anything else?
Yes, sir.
Jagdish sir, I have a few queries.
Yeah.
Can I please pose them?
Yeah. Please go ahead.
Sir, my first query is, there are various provisions for allowability of interest paid on loan taken for house property purposes.
Okay.
But could I capitalize this interest? Meaning, could I treat it as part of house property? If the answer is in affirmative, is it cost of acquisition or cost of improvement?
According to me, once the asset has been acquired, any expenditure incurred thereafter does not qualify as cost of acquisition. Acquisition cost is a cost which you incur to acquire the asset. Having acquired the asset, what you thereafter incur is either what we call it as a revenue expenditure, which could be allowable, it could not be allowable. Or now you're coming to your point, whether is it cost of improvement? I see no way how you can contend that interest is a cost of improvement. How does interest improve your asset? Interest is because you chose to borrow money instead of using your own money. Having borrowed money, I mean, interest is the cost of financing. It does not in any way improve the asset. So therefore, I would not agree that interest is a cost of improvement. Interest is undoubtedly, I mean, certainly not a cost of improvement. As to whether it is cost of acquisition, yes, interest up to the date of acquiring the asset is according to me a cost of acquisition, but thereafter, to my mind, it is not cost of acquisition.
Okay. Now, sir, my second query is, I draw your attention to section 45.
Yeah.
Now, 45 says, any profits or gains arising from the transfer of a capital asset effected in the previous year shall, save as otherwise provided in section so and so and so.
Yeah.
Now, sir, there are 13 sections
Yeah.
under capital gain chapter which give various benefits to the SSE.
Okay.
But only 9 sections out of those 13 sections have been mentioned in section 45.
Yes.
What is the importance of this? For instance, section 54 EC.
He is not here. Yeah, I'm aware.
It is not here, but it is most commonly used by all of us.
Correct.
What is the importance of it?
The important point, possibly in the context of 50C, I can argue that the 9 sections mentioned here as a carve-out constitute a separate code by itself. Therefore, I will first go and examine whether I am exempt under 54. If I am exempt under 54, I will not come to 45 at all. If I don't come to 45, the question of setting off the brought forward losses, etc., also does not arise. Whereas qua the other sections, there could be some debate as to whether I will first get the benefit of 54 EC or I should first set off the brought forward losses, which I have, if at all, which are available for set off against capital gains over here. But for that, I mean, I do not see any difference over there.
So this is not a drafting error, but it is an intentional omission.
I would believe so, yeah. Because these 9 sections have been kept out of the charge. So
exactly.
And one can possibly argue that because there is a distinction, as you rightly pointed out, of 13, it is only 9 which are there. Therefore, these 9 constitute a separate code. Therefore, don't apply 50C over there. Could be one argument, one may have to take it up and test as to whether that argument is getting accepted or not.
But surely that does not prevent me from taking advantage of, let us say, 54F.
No, undoubtedly. Undoubtedly. No. Absolutely no. Absolutely no. The difference to my mind is that these will not form part of 45 at all. For the rest 4, you will come to 45, you will charge and then give you a deduction. Whereas those are akin to your section 10, something which does not enter your computation at all.
Okay, that means for these, I have to cross the threshold of 45 and then come to these.
For the rest of them.
Yeah, okay.
For the rest of them.
Okay. Yeah. Sir, there's one more observation. It's not a query.
Yeah.
You mentioned the case of Venkata Dilip in Madras High Court, where the division bench said that the Bombay High Court decision was more appropriate, where the money was not deposited. Yeah. So there's another decision of Madras High Court. It is a division bench.
Okay.
And this decision was rendered on 22nd of July 2020.
Okay.
Which said that if the SSE does not deposit money in capital gain account and yet completes the construction of the purchase within the specified period, benefit cannot be denied. Sir, the case title is CIT versus Umayal Annamalai.
Okay. Okay. Is it reported?
Sir, I checked up my site. So it is apparently taken from the High Court site. But sir, my question is, now this is a division bench judgment.
That is also a division bench.
That is also, so the later judgment of division bench judgment, they, as per judicial discipline, they should not have commented on it. It needed a larger bench.
Correct. So this is per Giriam, but the point could also be, I mean, if I have to argue, I would say that there in the decision which I pointed out, the Madras High Court has said prima facie. They are not expressing a final opinion. Prima facie it appears. But here it is, so here between the two, I would say that the second one prevails.
Second one meaning
the one you are referring to. Because the earlier one only expressed a prima facie view. It was not a considered view.
That was, the original was in November 19. Now the division bench you referred, I don't have the date really. And this was in July 2020.
Yeah. In fact,
So-
I would not go by the dates. I would go by, I mean, in these cases, in both these, I mean, specific two instances which we are referring to. The first one is the court itself directly says that it is prima facie saying that.
Exactly. The
So
only
therefore,
point
that
of
is just an observation. I mean, like, in the passing they said it, fine. But in the subsequent one which you are pointing out, July 2020 or whatever it is, right? That I would feel is the ratio of the Madras High Court,
so we can safely follow it.
subject to Bombay High Court.
Thank you so much, sir.
I would personally prefer Bombay High Court.
Thank you so much, sir.
Yeah. Okay.
I hope you share the PPT with us.
Yes.
Yeah. Part selectively.
Thank you so much, sir.
Thank
Sir, we shall see the rest of the questions, sir.
Okay, you have rest of them. Okay.
Yeah, yes, sir. Yes, sir. We
Okay,
have
okay.
3 to 4 questions.
Okay. Okay. Can you take the screen up, ma'am? I can't read the question.
Okay, I'll read the question, sir. HUF realign the shares of properties.
This I answered. This I already answered.
Answer.
Family arrangement does not amount to a transfer. But I do not know whether an HUF realigning shares is family arrangement or not. See, the question is, does family arrangement amount to transfer? Family arrangement does not amount to a transfer. Yeah.
Question by Vimala Madam. When the 3-year period is available for construction of a property to avail capital gain for having sold a residential property, but in the meantime, the individual sells a long-term capital asset other than a house property and invest in house property as per the proviso to section 54F, but has yet to commences construction for the first capital gain. In that case, will the individual be allowed the construction, or he has to forgo the construction as he is not allowed to purchase or construct within the period? Then how can the individual use the amount in the capital gain account scheme to avoid capital gain tax?
Here it is possible that qua both the gains you invest in one house. But if you are talking of 2 houses, then it is not going to be possible. You will have to first purchase a house for the purpose of 54 and then come to 54F. Where otherwise you will be contravening the provisions. I mean, as you have rightly pointed out, you will be contravening or you will be violating one of the conditions of the proviso, and therefore you will have to lose the exemption under 54F.
So whether construction of a house made on a leasehold land
Yes,
will
it
also
will
be considered as investment.
Yeah.
Okay, sir. When the construction of the property is in progress and it is not fully completed within 3 years period, but the full amount of capital gain is spent on the construction, in that case, will there be any difficulty in allowing the exemption?
Literal interpretation of the provision, answer is yes, but you have plethora of case laws. If you can give a valid reason as to why there was a delay, the courts have been very, very liberal and courts have been allowing the exemption. They have said that yes, as long as the investment is made, so what if the construction is not over within a period of 3 years? I mean, you have several decisions. I had not covered that in my presentation, but there are ample number of decisions on this.
I think one more last question, sir. That is, it's asked by Bhuvaneshwari. An assessee, when non-resident, invested in mutual funds of Singapore for $1,000, he sold it for $1,100. At the time of sale, he was resident in India. Whether $100 is taxable or the conversion price at the time of purchase and sale is taxable?
Conversion price, because he was a resident at the time of sale.
Given an example also, sir.
Yeah.
At the time of purchase, conversion.
Yeah. So you have to convert it. You'll have to apply the conversion.
Yes, sir. I think all the queries have been answered. Sir, thank you. All the queries has been answered, sir. Thank you for your patient answering for all the queries raised by our members, and thank you for the excellent and detailed presentation, sir. Thank you. Yes, sir. We shall adjourn the meeting.